What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Happy Friday. Hope you're all doing well. Hope you have big plans for the weekend to get outside and enjoy some fall weather. I know it's definitely fall here where I live, and I live in Florida, and it's still getting pretty chilly in the mornings and overnight. It's a great time to get outside and do a fire pit, grill out, something like that. So I hope you guys have big plans for the weekend. What I plan to cover today is kind of a grab bag of things. Last week, I went over this geopolitical risk. I responded to Bob Elliott and Michael Green. They were on Blockworks. That was a really good episode, I think, but my audio is all messed up. So I'm going to go through that again. I did write up all of these arguments and put them out on a blog post on bitcoinandmarkets.com. Let me go to that. So bitcoinandmarkets.com is the home base. And this morning I put out bank credit shows deflation is here. That is for paid members at the professional tier. And yesterday was this Bitcoin is a hedge against geopolitical risk. So let's go into this. Oh, and what else am I going to cover today? I wanted to cover a little bit about inflation and a little bit about the Fed rate monitor tool, what the people over at the Fed are talking about, and yeah, go from there. So let me bring this back up. Where am I? Okay. Bitcoin as a hedge against geopolitical risk. And Bob Elliott and Michael Green, they appeared on a Blockworks podcast. And I recommend just go find their YouTube channel. I'll share the link out on my Twitter and on Telegram to make sure you guys have a link to that. But starting at about minute 49, they start talking about Bitcoin. And their basic premise is that Bitcoin has not performed as a hedge against geopolitical risk in the few days since the Israel-Gaza war started, or as an inflation hedge during the recent spike in CPI over the last 18 months to 2 years. Bob says, quote, "We have to be honest, and it failed. That is not true, and I'll detail why." I probably wouldn't have cared too much about this other than, he's trying to claim that Bitcoiners like myself, which I have a very contrarian or very unique outlook on Bitcoin and on macro. And I'm definitely not in the, pure inflation hedge camp for Bitcoin. I'm not in the Bitcoin fixes this camp. I mean, I kind of am, but I think it fixes it in ways that some people might not think is actually fixing. So, I'm coming from a unique angle to this, but, he was saying we have to be honest, and he was not being honest. So I felt like I had to respond to that. Okay, so Bob's claims have two false premises built into it. Okay, the first one is that this period was a period of particularly high geopolitical risk. And it still seems that way. At least they're still trying to convince us that this is a very high geopolitical risk time. Biden going over there. There was some stuff with rockets coming from Yemen or something, and some destroyer in the Red Sea shot down a missile, and then there's all this stuff with Beirut. It almost seems like they're trying to push really hard to make this a broader conflict when it started, right, under very suspicious circumstances in the first place. But it just feels to me like they're trying to make this particularly high geopolitical risk, but the markets are not responding. So, and then his second false premise is a hedge against geopolitical risk should react immediately and emotionally at every event that might be a geopolitical risk. So he compares it to gold and bonds, and both of them seem to rally in the first few days after this conflict kicked off. And he used that as those are real hedges. Bitcoin failed to be a hedge because Bitcoin actually went down after a couple of days. But anyway, so let's dive into these a little bit more individually. So this is the period of particularly high geopolitical risk. It might come across as ignorant to say the Israel-Gaza war is not a period of high geopolitical risk, but let's let the charts talk. While it is a tense time, it pales in comparison with other recent events like Russia versus NATO. We don't even know why it happened, and that is the Israel-Gaza thing. I mean, we know the background of the entire situation, but we don't know how this particular event, why this particular event was able to happen. Why was the most sophisticated and guarded border in the world left unprotected? Not just initially, but for hours after the attack started. It was like 6 hours before they responded. Who was involved as far as funding, planning, and training goes? What is true or fake news? We are inundated by visuals of these people's supporters rallying around the world, and is the Israeli government officials using extremely violent rhetoric. Stories of events on the first day were the subject of heated back and forth with very little supporting evidence. I mean, just think now, we don't know exactly what's going on over there. But the first 24 hours, we knew nothing. All there was propaganda. How is Bitcoin supposed to respond in that type of environment? I don't think it's as easy as saying, oh, Bitcoin should have responded positively, As Bob requires, let's be honest here. What, who, how, why are not clear at all in this situation. Why should we conclude that this is highly geopolitically important? The market seems to agree that it is not a particularly high risk level. War in the Middle East with allegations of Iranian and Qatari involvement, with US politicians calling for bombing Iran, and the oil price drops in the first few days? Come on. Can we be honest here? All right, so let's bring this up. So you can see this is a hourly chart of WTI crude. This red vertical is the time of the attack. It happened, Friday at 10 p.m., I believe. Markets were closed. Oil was not trading. How can this be a geopolitical hedge when it can't even trade? So it's only a geopolitical hedge from Sunday night to Friday afternoon. Friday night, Saturday, Sunday morning, it's not a geopolitical hedge because you can't trade. Okay, so the attack begins over the weekend. WTI gaps higher, but only 2%. I mean, it wasn't on the bigger chart. If you zoom out, and look at a daily or weekly chart, this gap is nothing. It's nothing compared to when OPEC made a simple, 1 million barrel cut announcement. And this is war in the Middle East with bombing Iran and stuff. I mean, this should have had a bigger response than that. But then over the next 4 trading days, it actually sold off and closed the gap, filled the gap. So this was a technical move. This market did not care all that much about what was going on there. The market did not see this as a very highly geopolitically important period. Yes, from this period, it has gone up from about the 12th to today. It has gone higher. But I mean, there was a bull div here, and it was just a technical move, especially because it's still off the recent highs of $95 a barrel. It's barely holding on to $88 a barrel right now. So and here we zoomed out, and the attack begins here at this red line again, and you can see we're still 5% below the high close. Hold on a second. Sorry about that. We're still 5% below the week prior to the attack. And this is war in the Middle East, people. I don't understand how you can look at this chart and be like, oh, this is highly geopolitically tense. No, nothing happened to the oil price. It didn't even make it past technical resistance and stuff. Okay, so that is not how a market would react to a massive geopolitical risk of war in the Middle East and US politicians threatening to bomb Iran. If the market viewed this event as a massive geopolitical event that Bob and Michael are claiming that it was, we would expect oil to rise relatively rapidly, not just make technical moves. we can use more charts. What about gold? So he talked about how gold was acted as we would have predicted for a hedge against this geopolitical risk. Gold was cited by Bob as trading as it would expect. Okay, what he either doesn't realize or is purposely avoiding is that gold also is just making a technical move. I pointed it out days beforehand. Gold was the most oversold since 2016, right before this event, and coming into horizontal support. It behaved exactly as the technical setup would expect. So let me bring this up. If I can click into here. Why isn't it letting me click in? I don't know what is going on here. So you can see that there was this bear div at the top. It came down into a retracement of right around the 61.8 at the prior low from March of this year. And I'm saying it's the most oversold. You can see down here in the bottom right-hand corner is the most oversold on the RSI since 2016. I'm saying this is going to bounce. And what happens? Then the Israeli thing happens and it bounces. So was this due to the Israeli thing, or was this due to just being a technical bounce? Let me check on my levels. Had a sinking feeling here. All right. So if I were to show you the above chart with all the axes hidden, I have a typo there, and you didn't know that this attack had just happened, and I ask you to point out the period of high geopolitical risk, would you pick the little rip at the end? So, if I just showed you this naked chart and said, where's the geopolitical risk? Would you pick this little tiny rip at the very end? No, absolutely not. You'd probably pick February of 2022 or late 2022 when it's turned around here at the bottom and started going higher. Those might be the periods that you pick out off this chart. And those would be better because nuclear war with Russia versus, this Hamas invasion into Israel under questionable circumstances. Which one is higher geopolitical risk? Anyway, the current conflict is nothing compared to nuclear war. There is plenty of propaganda, but the markets tell us it is not significant risk at this time. Bob and Michael also claim that, quote, we have a sample size of 1, and Bitcoin failed that sample size of 1. I don't know what planet these two guys are living on. Maybe they don't remember February 2022. Maybe because they were wrong on their calls back then. I don't know, but maybe they got everything completely wrong and they just totally forget that February 2022 ever happened. The Ukraine war is not over either. Recently, under cover of this manufactured geopolitical crisis in Gaza, the U.S. shipped ATACMS to Ukraine. These are ballistic missiles, not nuclear missiles, but ballistic missiles. They can go, 500 to 2,000 miles, something like that. The U.S. gave crackheads in the Azov and in Ukraine ballistic missiles to fire at Russia. Perhaps any reaction in the market is due to that escalation and not Israel. How do we know? How do we break it apart? We don't know. Crimea was initially annexed in 2014. Bitcoin was around for that. The Syrian civil war started in 2011 and is still going on, along with fighting ISIS, threatening Middle East peace. Russia was there too. Do you remember Turkey, a NATO member, shot down a Russian jet in 2015? A NATO member country shot down a Russian jet. That's more highly geopolitically tense. Bitcoin was here for that too. The armies of nuclear powers, India and China, fought on their border in 2020, and something like 100 people died with fists and bayonets and stuff. That's a pretty high geopolitically tense time, and Bitcoin was here for that. The sample size for how Bitcoin behaves in elevated geopolitical stress is its whole existence. It's not a sample size of 1. It's a sample size of a whole lot. It is a relatively new field of study, but here is a study from 2022 that runs detailed statistical analysis on Bitcoin and gold against an index of geopolitical risk. They find the following, and I link to this study. The present research is the first, to the best of our knowledge, to compare the safe haven abilities of Bitcoin and gold with respect to different geopolitical risk indicators, namely US-China relations, global trade disputes, Gulf tensions, European fragmentation, North Korea conflict, Russia-NATO tensions, and major terror attacks. To do so, we carry out a flexible cupola approach to shed new light on Bitcoin and gold safe haven statuses under low and high geopolitical risk regimes. Having shown heterogeneous Bitcoin and gold reactions to the 7 aforementioned geopolitical risk measures, we develop a composite index that summarizes seven factors within one risk measure. Our results consistently reveal a positive and significant relationship between Bitcoin returns and geopolitical risk under rising geopolitical risk periods. Similarly, for gold returns. So, what are they basing their stuff on? They're basing their stuff on 6 days of propaganda and emotional trading, and comparing it to gold and bonds. And then that means, let's be honest. If we're honest, we will agree with them that that stuff is important and Bitcoin failed. It's completely disingenuous. Okay, how should it behave? So how should a geopolitical risk hedge behave? Excuse me. Bob and Michael claim that Bitcoin did not perform as we would expect. Okay, they claim geopolitical hedge is supposed to rise immediately in reaction to the event. Forget that I just showed that the markets didn't agree that this was a particularly important event. These men might dispute that this is their claim, but that is the standard they are holding Bitcoin to, saying it failed. So, obviously they're probably going to try to back out of this and say that I'm not applying their standards properly or what they're actually saying, but that is what they said. Bitcoin failed because this highly geopolitically tense, gold and bonds went the other way. Bitcoin failed. And we have to be honest, guys. Specifically, they imply a safe haven asset would have immediately, in the fog of war, emotionally reacted to news events within days. That is not the case. The term hedge has at least two related but different meanings. First, a hedge is something that offsets a directional move in something else. I'll call this a mechanical hedge. This would include directional trades like shorts or more complex trading strategies. These types of hedges are, by definition, perfectly inverse or indirect. Mechanical hedges look to create returns by themselves or returns to offset losses elsewhere. Second, a hedge can be an asset immune to geopolitical risk. This type of hedge is not necessarily looking to make a return, but to limit losses. They do not mechanically react to events or price movements. So shorts, are by definition hedges against contrary moves. But a hedge, an asset that acts as a hedge, doesn't mechanically react what they want it to. The Bob and Michael want all types of hedges to mechanically react like a short position. They will not perform in a narrowly prescribed manner like the first type. I call this type a general hedge. They have their own market dynamics, but are a hedge because their fundamentals are insulated from rising geopolitical risk. They might not perform well at the outset of a crisis, but will catch up later. Perhaps they spike early, but fade. Even though geopolitical risk may continue to rise over an entire period of, say, months, the asset will end the period higher than it started, even though it fades towards the end. The way gold and bonds behaved in the few days after the attack on Israel, used by Bob and Michael as evidence that Bitcoin is not a geopolitical hedge. Okay. That was a bad sentence. They are right. Bitcoin did not perform like a short or a mechanical hedge. but it is a general hedge. Okay, what about inflation hedge? Because I also said Bitcoin has failed as an inflation hedge. As a bonus, I'm going to discuss Bitcoin as an inflation hedge because Bob and Michael bring that up in the podcast too. They claim Bitcoin is not an inflation hedge based on its performance in 2022 against CPI alone and disregard all other data. Bob wants us to be honest, so let's do that. Inflation and CPI are not the same thing. If I were more cynical, I'd assume these men were not arguing in good faith after claiming we need to be honest. Perhaps it is a little subconscious projection. Inflation and CPI are not the same thing. Inflation is money printing. More specifically, in a credit-based currency, it is net credit creation. CPI is a basket of prices that is meant to be a proxy for inflation. CPI closely follows energy prices, which can be drastically affected by non-monetary events, as discussed above. It is slightly ironic that in the same episode, these guys go from claiming geopolitical events can cause price movements and then implying that price movements are inflation. There is a deep dissonance in that thinking. And this is obviously, you guys listen to my content, you know, this is one of my crusades here is to try to get people to understand that CPI is not inflation. Okay, let's define an inflation hedge. An inflation hedge protects you against losses due to a rise in the money supply. As the units of money go up relative to things in the economy, more money chasing the same amount of goods, it is logical that assets in more inelastic supply with more inelastic supply curves would retain more of their purchasing power. There could be some assets that disproportionately go up when money printing occurs, but as an inflation hedge, we most commonly are referring to assets that keep up with inflation. An inflation hedge is a logical construction. That's very important. An inflation hedge is a logical construction. You don't need to go and find empirical evidence for this. I mean, you can, but because there's all these other market dynamics for a general hedge, you know, there might be periods where it underperforms and then periods where an asset will overperform. But calling something a hedge, an inflation hedge, is a logical construction. Assets whose supply is relatively fixed will tend to perform better during periods of inflation. To say that the first asset in history with a fixed supply is not an inflation hedge will take more than just an arbitrary time frame comparison. A logical argument has to be made. Why would a fixed supply asset go down in value in a period of inflation? Bob and Michael's dismissal of Bitcoin as an inflation hedge centers again around two false assumptions. One, CPI measures money printing and in 2022 was significantly inflationary. And two, that Bitcoin didn't outperform CPI. On the chart below, we can clearly see that money printing, bank credit, comes right before bottoming in the CPI and the start of the Bitcoin rally. So let's open this up. So money printing in blue, this is bank credit. It pops. CPI bottoms here like a month later, and Bitcoin starts its big rally. 1, 2, 3. Logically connected. Okay? Once credit creation slowed, Bitcoin rises slowed. So here in early 2021, money printing in blue went down. That's when Bitcoin rate of increase started going down, right on time. Then there were some internal industry problems for Bitcoin forcing price down in 2022. However, it is still massively outperforming bank credit and CPI. Also, as an aside, notice the bottom right above, deflation hedge up here. Deflation hedge. Bitcoin is also a deflation hedge. When bank credit is contracting, Bitcoin is a deflation hedge in a credit bust. Okay, then this one is, let's go to here. Because I thought I had more time, guys, but I'm running out of time quick here. So Bitcoin here in green, this is percentage return going from the COVID crisis or just before, like from January of 2020. You can see Bitcoin has returned 241%, where bank credit has only increased 24% and CPI has only increased 18% total over that time. So Bitcoin, even though this is a very high CPI time, Bitcoin outperformed both of these measures. Okay, year by year performance. So let's take a look at 2022. You can see here bank credit is up 9%. It's this one down here that's not filled in. 9%. CPI is 1%. Bitcoin is 386% in 2020. Then we go to 2021. This was the highest period of CPI and credit creation, 10 and 8% respectively, and Bitcoin returned 30%. So that's pretty good. 2022, the CPI and bank credit slowed to 6%, but Bitcoin dropped by 55%. This is the one bad year due to the internal industry problems that Bitcoin had. But so far, it's still ahead. It's still ahead. Remember, it returned 300% that first year. So far in 2023, bank credit is contracting at -1%. CPI slowed to only 2%, and Bitcoin is up 68%. So, all right. Lastly, let's put a stake in the inflationista narrative. Certainly, post-COVID must have been abnormally high credit creation if CPI got to the highest in 40 years, right? Nope. It didn't even reach the near consistent heights pre-GFC. So if we bring this up, you can see here from 2000 to the Great Financial Crisis, probably averaged almost 10% credit creation, and we barely got to that here in a post-COVID. So this was actually a lower period of credit creation. All right, and that's it, guys. So hope you enjoyed that. I don't have time to get to my other topics. I'll have to do that another time. But thanks for joining me, and I'll see you guys on the next one. Peace.